This is a warning and a call to action for the entire real estate industry to acknowledge the fact that we are being disrupted, and if we don't do anything about it, the scale of financial destruction is going to be nothing short of biblical. We are in the very beginning innings of a multi-cycle secular devaluation and recalibration of how real estate is utilized and operated. And meanwhile, most people are too busy taking victory laps about 100% bonus depreciation. Everybody watching this video has enjoyed the privilege of real estate being the apex financial asset in global markets. And for the first time in 50 years, that is no longer the case. Real estate has been dethroned by Bitcoin. And we as an industry need to acknowledge that and start having open and frank conversations about what that means and how we're going to move forward. Now, I need to provide a little bit of historical background here. The entire game changed in 1971 when we abandoned the gold standard for this fiat experiment we find ourselves in today. Real estate benefited disproportionately relative to other assets because lending against real estate was the primary mechanism for getting new capital into the market. Now, over that period of time, 1971 to today, the monetary base has expanded on average 6.8% per year. Over that same period, commercial real estate grew 4.4% on average, and residential 5.7% on average. So that 2 to 3% inflation number was just another lie we've all been sold. CPI targets are just targets. We never came close to hitting them. We aren't even in the same ballpark. In order for the economy to continue growing, they had to expand the monetary base. That's a fancy way of saying printing money. And owners of real estate and other assets benefited the most. I don't know if this is going to be a news flash for anybody, but the fact is most people don't buy real estate for the real estate. They buy it because it's their savings account. Think about the stories. Your neighbor owns 3 or 4 Airbnbs, or you read in the Wall Street Journal that some Middle Eastern billionaire just paid a record price for a condo in New York City, only to let it sit vacant. Why is that? That's because capital is seeking a safe haven, and they can't put those dollars into a bank account to earn a couple basis points. So what do? They do the next best thing. They put it into a hard asset that is going to track the rate of monetary debasement better than pretty much anything else until they're ready to redeploy that capital to other uses. They sell the property, next guy comes in, process repeats itself. This behavior over 50 years has massively distorted real estate values. And in past cycles, there had never been a solution, there had never been an off-ramp, there had never been an alternative until today. Bitcoin is that alternative. In every way, Bitcoin is a superior financial asset. There's no vacancy, no maintenance, no carry costs, no jurisdictional risk, no commissions. It's got 24/7, 365 liquidity. You can lend against it. And oh, by the way, it's growing 60% per year over the last 5 years. And if you expand that to 10 years, it's closer to 80. So I find it really hard to see a scenario where Bitcoin does not absorb a significant portion of that monetary premium that real estate has accumulated over the last 50 years. Now, the one knock on Bitcoin has been that it doesn't produce a cash flow. In 2025, that argument is largely moot. There are financial products available today to any level of investor that provide a cash flow stream based on Bitcoin. The blue chip in this space is a company called Strategy. Their chairman is a guy by the name of Michael Saylor. You may have seen him making his rounds on CNBC, Bloomberg, different podcasts, what have you. His company has to date issued 4 offerings. Each of them are geared toward a different type of investor, different type of capital. They have different risk and return profiles. Strike, Stride, Strife, and Stretch. You can look them up. They are senior in the capital stack. They are over collateralized by the hardest money humanity has ever known. That's Bitcoin. They pay an 8 to 10% annual dividend, and they're liquid. Your money's not tied up for multiple years at a time. So whether it is spot Bitcoin or any of these adjacent products, they are going to start serving as the hurdle rate for capital and investment decisions. So that 5 to 7% annualized return, your capital's locked up for multiple years. Maybe I get a cash call, maybe I don't. That's not going to cut it anymore. Our industry has become so accustomed to these large institutional funds, Blackstone, insurance companies, pensions, what have you. They got $100 billion a year to place into real estate. There is a portion of that capital that is going to naturally migrate to these products. So what happens when that $100 billion fund becomes 90 next year? And the year after that it's 80, and the year after that it's 60, and so on and so forth. One player, no big deal. You start to add up all these participants, and you start to get to a scenario where you have a $500 billion, trillion hole in the market each year. That has massive implications on valuations, on leases, on loans, everything. So again, we as an industry have to acknowledge this, and we have to come together and figure out the best way forward. This is not just going to impact Wall Street, it's going to impact me and you and everybody in between. Now, I want to be very, very, very clear. I am not saying that real estate is going to zero. Far from it, actually. Real estate plays a vital role in human society: shelter, community, business, and culturally. What I am saying is that what it means to be profitable and successful in real estate in the years to come is going to get exponentially more difficult. I personally think that's a good thing. It's going to flush out a lot of malinvestment, and it's going to separate the true pros from the wannabes. Now, if you are going to be in this industry moving forward, you are going to have a real and comprehensive strategy that you apply to every asset or across the portfolio. The traditional value add strategy of buy a property, make some cosmetic upgrades, rebrand it, push rents, and sell it for a nice multiple in a couple of years, that game's over with. So again, the successful investor and developer is going to have a comprehensive strategy that solves for the user experience and the operational efficiencies. I've come up with 4 categories that optimize this. One is modular improvements. If you're going to reconfigure a space every time a lease expires or a tenant moves out, that is capitally inefficient. There are solutions today that allow you to, it gives you the flexibility and appeal to a broader scope of end users. There's also a residual value component that falls directly to your bottom line. The second category is your energy consumption. Our industry is doing a good job of energy efficiency and talking about the energy transition, whether it's solar, battery technology, different sensors, what have you. But I also think there is a huge opportunity to incorporate Bitcoin mining. I'm really fascinated on this topic, and I'm excited to see where it goes in the years to come. The third category is technology integration. This is AI, automation, and IoT devices. This category will touch the user experience, and it'll touch the operational efficiency. Users can customize their experience, and operators can get real-time data that allows them to make informed decisions. This lowers the cost of operations, and it extends the useful life of infrastructure. The fourth category is hands down the most important of the 4, and that is your Bitcoin strategy. Your Bitcoin strategy is going to consist of treasury management, dual collateralized loans, and how you raise capital. The investors and operators that are fluent in these 4 categories and can implement them properly, they are going to outperform massively. They are going to generate returns that we've only dreamed of to date. That said, I want to acknowledge the fact that we as an industry have been conditioned to believe that all real estate goes up all the time. And that could not be further from the truth. This cycle and future cycles, that gap between the good properties and the bad properties is going to widen dramatically. And it will play an integral part in what projects are successful and those that aren't. Depending on what source you look at, there's about 87 billion square feet of commercial property throughout the United States. That's office, industrial, retail, and multifamily. About 62% of that, 54 billion square feet, was built before 1990. That is functionally and economically obsolete. It was built in a different economic, regulatory, and technological era. It falls far short of the demands and expectations of consumers, businesses, and tenants of today. So I think this is also a good thing, ultimately, because it's going to reinstill the integrity in the site selection, due diligence, and underwriting processes. It's going to make them great again. Now, I would be remiss if I didn't bring up the fact that we cannot do this alone. We as an industry have to engage our elected officials at every level, local, state, and federal, immediately. And we need to have an informed discussion, a transparent discussion with them, and also impress upon them the sense of urgency here. This cannot take multiple election cycles. This cannot take 3 to 5 years. This needs to happen now. We need to come together and figure out the best path forward. Because if we don't, the downstream implications are catastrophic. Now, if we do come together, and I'm optimistic that we can minimize the scale of disruption. We can make the transition seamless, a little more seamless. And I'm truly a believer that what awaits us on the other side is extraordinary. But it's not going to happen on its own, and it takes us getting involved and getting active and getting educated and having uncomfortable conversations that you probably don't want to have. Now, I know I've covered a lot of ground here today, and in future videos, I'm going to break down each of these topics in more detail. Today, I just wanted to share my framework and broader thesis for the industry. I hope this is going to serve as a launch pad for ongoing discussions. I'm not pretending to have all the answers. I'm learning in real time, just like you are. I want to hear your ideas, and I hope you'll give me feedback on mine. But I'm optimistic that we can leverage our collective brainpower as an industry and come up with viable solutions. I want you to comment below, DM me, share this with your colleagues, share it with your clients, spread the word. We need to get everybody involved here so we can get the best ideas possible. My name is Chris Drizga. I'm a 15-year veteran of the commercial real estate space in the Southern California markets. I focused on office and industrial properties both as a broker and an investor. I'm also a Bitcoiner for nearly a decade now, so I'm eating my own cooking in both of these asset classes. I appreciate you spending your time here, and I look forward to continuing the conversation.